So I think at this point, feel free to ask questions in the chat. We've gotten one already, which I'll kick off with. And I think I would add that if you have questions for both of our excellent intern presenters, I'd be interested to hear answers to those. So to start, Matthew, we got this question in the chat. What % of the fund returns are derivative related, and what % are long-term holding equities?
That is a very good question, Danielle. I'm going to stop sharing my screen first, and then maybe my image will be a bit larger. What percent? You know, it's a good question, and it's actually a somewhat common question from folks. It really depends on the year and the situation. So what I can share with you is that the structured dividend position is somewhere around about 25%, and that is mostly derivative related. I mean, we're picking up dividends, we're getting puts and calls and things, but of that like 41% we talked about, that would be primarily affiliated with the derivatives. What we're doing when we're selling a put as a tool to purchase the equity is really looking to get ownership of that equity. And once we own the equity, that becomes an equity holding. So then it becomes this question, what percent of that was from the original premium versus how long we've held it. So, we've been selling puts on Berkshire Hathaway since 2011. We've picked up premiums all along the way, and we have, in some cases, we just hang on to that cash, and in other places, we're fortunate we get put the shares. So it's not. People want a straightforward answer, I think, but there's not really a clear answer. It's because we have a pretty developed portfolio. I showed you our long-term compounders. Those are equity compounders. So, if we have 60 or 70, let's say, % of the portfolio in those 6 holdings, that is, the results of those are going to be equity gains. We're getting, I would say, it's probably 60 to 70% come from equity would be an average, and maybe 30 to 40% is coming from premiums that we're receiving from various put sales, or if we're exiting a covered call sale.
May I just thank you very much, Matthew? May I just have a follow up to that?
Yes. Is this Toby?
Yes, Toby Baxendale speaking from the UK. Well past my bedtime, so forgive me if I'm incoherent or anything. Would it be fair to say that those derivatives are more a byproduct of your long position? Because they do seem to be related to companies that you're interested in owning, as you've just said. Anyway.
Absolutely. That is the only time we're applying our structured value strategy is when we want to take ownership of the underlying position. So we are using it primarily for an opportunity to basically to buy, say, more shares of Berkshire Hathaway, or to move into further position in Seritage, and otherwise we wouldn't be doing it. The only exception to that is I did mention in the prepared comments some of the structured dividend capture. That is slightly different, but in the same way, we are trying to take ownership of those positions because we want to pick up that dividend. So we are only writing these contracts on positions we want to own.
Yeah, thank you for the clarity. It's very helpful.
Thank you. Great question.
Thanks. I love the follow-up too. To follow on that, with the structured dividend capture strategy, can you talk a bit more about the risks there? It seems the risk might be getting stuck with a stock in that interim period when you own it. Can you talk about your views on risk and how you manage that risk? And then secondly, how you choose the companies that you're using in that strategy?
Yeah, definitely. And of course, it's a pretty unique situation we've come across here. So each individual position, I know we've kind of walked through that waterfall looking Gantt chart where we're talking about the capital rolling through. We need to make like a simple way to sort of explain this, but we actually have a basket of these securities. So it's not like we're not really exposed very much to any single position. So we may have 10 or 12 that we're going through simultaneously. So each individual holding only represents like 1% of the portfolio capital. It's very small. So even if there was a position, and you know, we've sort of normalized this and looked at stress testing different components, we expect generally to have, you know, some positions that move up a lot, some positions that fall a lot, and maybe 8 of them stay roughly, you know, within like 2 to, you know, standard deviations of the mean expectation. So we sort of take a statistical approach to it. Any single position isn't going to do us very much harm. So the risk of, and by the way, we're holding it for such a short period of time. It's sort of interesting. Like there isn't really enough time, because we have done a little analysis, but there isn't really enough time for these firms to do something terrible to happen. But if there was a total market collapse, or you know, something did happen, what would happen is we would end up owning a bunch of these stocks like KMI and AT&T that we really didn't intend to hold for the long term. What's interesting that is that the dividend, unless they suddenly stopped, would actually become really large. And as I tried to show in the AT&T example, we actually held that during a period when the shares fell 7% and still came out up 3.6%. So a single position doesn't have much of a situation to harm us. If the whole market fell, we might own a few super high dividend paying shares, but maybe it's worth explaining. And then, you know, Danielle, you can tell me if this is clear or not. If it does happen where we sell a call as a tool to exit the position, and sometimes the price in the market is below that strike price. And what that means, it's usually not a lot below the strike price, usually just a little below the strike price. And what that means is we then can sell another call that expires the following week. So if we're getting paid 50 cents to exit a stock that's selling for $12, and we have a $12 strike price and it's $11.59, at the end of that week, we keep the 50 cents and we still own the stock. So we just sell another one for the next week and pick up another 50 cents. And frankly, if you do that a lot, you're actually making a really good return as well. So so it does happen where we have to sell calls, you know, for a few weeks to exit positions if they're not hitting our strike prices.
Okay, great. So we just got a follow-up question in the chat asking just again, what happens for that strategy if there's a severe market dislocation? I think you've answered that you would end up with some stocks that you maybe didn't intend to own.
Yeah, and I think
just expand a little.
Yeah, I think at the beginning, you had also asked how these were selected. So I will, hopefully this can be, hopefully this will give you confidence. It gives me extreme confidence. So the selection process, the whole filter process that we're using is already throwing up really reasonable firms. So these are all companies from the 13F analysis of our favorite 100 funds in the world. So these are owned by the Seth Klarmans. These are owned by Warren Buffett. These are the firms that these folks are buying. That is our starting point. And we're looking through this list of 300 or 400 companies. And then we're overlaying all of this data that we're getting from Capital IQ. So we're downloading all of the financial data. We're looking for any companies that are overexposed, have too much leverage, have big red flags, and we just throw them out. We don't care. We look at all the companies that are having abnormally high dividends. And some of the companies we might not be interested in because they look like they have extreme volatility, and maybe we don't understand them well, and we just don't want to have it in the portfolio. So it's a process of elimination, but it's the starting point that's so important. These are owned by the super investors of the world to start with. And then we're going and we're looking for everything to cover ourselves. And then we go in and we sell these puts at strike prices, you know, below the market price, even, where we're getting paid a high premium, paid a dividend, and paid a call premium to exit. we're picking up these 8, 6, 7, 8, 9, 10% gains in the course of 2 weeks. And because of our starting point and that we do this fundamental analysis, we're really confident that the companies we own are decent companies. I'm not saying they're the best companies in the world. They're great companies. Some of you work for these companies, okay? It's like ExxonMobil and Chevron, and it's AT&T. I mean, these are like blue chip firms. They're not going to disappear, and they're paying very high dividends, and there happen to be really high premiums right now due to all the uncertainty in the market.
One more follow-up on this structured dividend. We're getting a bunch of questions about it. Considering that the return on equities over the next 7 years is regularly forecasted to be fairly minimal, does that impact your thoughts about the structured dividend strategy? Does that change the way you've thought about it at all, or are you expecting something different out of the market?
So look, macroeconomic forecasts, everybody wants to have a crystal ball, but nobody has a crystal ball. So I don't think anybody can say some macroeconomic event will or will not occur. There are, for example, all sorts of debates about inflation going on. There's smart people on either side. The future is really unknowable. So I will answer the question, but we don't really know what's going to happen to equity prices over the next few years. That might have been a question referring to the fact that the long run average, multi-century average, is 6.8%. And that is true, 6.8% plus inflation. So does that impact? So first of all, let me address the portfolio in general. Just because the market does 6.8% plus inflation, that does not mean that we will do 6.8 plus inflation. The companies that we own, I expect to do far better than that. We are doing deep fundamental analysis, bottom up research. So we are going, we're scouring the earth for these gems that we can find that are, mispriced for whatever reason. Maybe they have things that are missing from their financial statements. Great management teams, great business models. They can do very, very well. So I expect our core portfolio of these compounders to do extremely well. The fact that interest rates are so low makes this structured dividend capture very interesting, because I expect, it's just so hard for people to earn yield in this environment. It's really interesting. It's like endowments and foundations and things. They're just going to struggle so much to get across their 7% hurdles, I think, because they have to have a bond allocation, and then you have to go way out on the risk curve to get kind of 3.5% these days. And this is like, it seems so interesting that we're able to just like print this capital. I mean, people are just paying us to buy a solid business, and then we're getting a dividend, and then they're paying us again to exit. And we're picking up these really astronomical returns. I mean, this is like, I've never seen that. This is just, it's a very special time to see this. I hope it never ends, but I'm sure it will end. And I think, yeah, so the fact that returns might be lower, I don't think it impacts the structured dividend capture position at all. What it means maybe is that the firms are stable. One thing that I will say about it is, because interest rates are so low and you've got all sorts of investors of all kinds, institutional, retail, in cash, it's actually I monitor the money market flows very carefully. It's quite interesting to see that the cash, the money markets now have about twice as much cash as they had before the pandemic, which means that people are still sitting in cash, but we're seeing inflation tick up. And at some point, people will recognize that their capital is being eroded. My belief, and again, I don't have a crystal ball like anybody else, but if I were the chair of an endowment and I had to decide where to put my capital, and I'm looking at treasuries paying 1.5% and inflation at 5%, there's no way I can get away with, I can't justify, I mean, I'm going to lose purchasing power. So what I would be thinking about is, where can I capture a stable company with a good dividend? And I'd be much more happy to own a bunch of these businesses that are actually in our dividend capture position, as a sort of picking up the dividend yield. And then you also have some upside potential in the stock. So I think we're in a pretty good position. And I think some of the holdings will be recognized down the road as being really good places for capital.
Wonderful. Okay, let's move on from those. And everybody who has additional questions on that subject, go ahead and ask, and we can come back to that if there's additional follow-ups. But to move on, so this is a question from James. He says, congratulations. It's so rewarding to see your process, which is repeatable and unique, create alpha. And earlier in your presentation, you mentioned that the S&P 500 has performed very, very well beyond its historical performance, and that you expect that performance and growth to slow, as you were just talking about, and for your fund to outperform. Could you just talk about more about why you see that dichotomy happening? Why will the S&P slow down while the Peterson fund outperforms?
Yeah. So the S&P 500 has been this formidable competitor over the last year, or I should say 10 years. I don't think, every year the talking heads are sort of commenting on how the S&P can't continue at this pace, and then it goes up another 17%. And it is just, it's actually quite difficult for value fund managers. It's been very difficult for people to keep up. And the S&P 500 is actually driven by a few large positions. So a bunch of the FANGs are in the S&P, and they're actually great businesses, and they've pulled it up considerably. But if you look at the data, so Jeremy Siegel, who's the chair of the Wharton School, has put together data in his book Stocks for the Long Run, and he analyzes stock data from 1801 until today. And in fact, he analyzes not only stock data. I have this slide I'm going to share here, if I can share it easily. He analyzes, let's see, am I going to be able to? Sorry, I don't want to take too much time trying to share something, but he analyzes you can see this, Danielle. So here's an image that I think it's worth understanding. This is data. This is from his book Stocks for the Long Run, and it's really consistent. He talks about it for a couple chapters. 1801 to 2001, stocks. This is logarithmic scale, of course. Stocks are growing. First of all, it's notable that they're the best performing asset class in orders of magnitude. So the dollar over 200 years becomes worth 6 cents because there's inflation. Gold is worth just under $2. So gold is a nice hedge at times, but really it's not a good investment. Bills are at 300. Bonds, a dollar grows to 1,000. Stocks, it grows to 755,000. It's just enormous. I mean, these entities are designed to organize and build capital, and it's working. In his analysis, what he has found is very consistently, the average is 6.8 plus inflation. So an after inflation return of 6.8 is about what you would expect to get if you're in a broad index like the S&P 500. So if you have a situation where the S&P 500 for 10 years has returned 17% annualized, we are just so far, we're in such an outlier category that I am really confident that this time is not different. We will likely have still average 6.8 plus inflation. So, we haven't had any much inflation over the last 10 years either. So this has been a really true outlier, and I'm really confident that it will, we'll have reversion to the mean in this scenario. again, the reason I'm saying that we can perform better and will outperform is that the positions that we hold are growing a lot faster than that. And ultimately, because our businesses are growing faster than that, the stock price, I don't know what the price will do in the short term. I don't really know what it will do over a month or quarter, even a year sometimes. But in the long term, the price of the stock will reflect the value of the business. And the value of our businesses are compounding at very high rates of return. And so the stock price is likely to follow. And if we see an overall slowdown in the growth in the S&P 500, which I would expect over the next decade, it doesn't necessarily impact our holdings, and our holdings can end up outperforming by even a wider margin when the S&P isn't doing so well. So James, hopefully that answered your question.
Wonderful, thanks. So I'm going to move on to a few questions about specific fund holdings. First of all, Naspers. It appears Naspers was added probably within the last year, and wondering if you want to talk at all about that. And secondly, the question is, how does the Naspers management team think about capital allocation and the opportunity set they have?
Yeah, these are great questions. And typically, because of the commitment and consistency biases, we try not to talk about current holdings, but over the years, I've sort of recognized it's sort of an interesting dynamic we have, because we have these like long-term compounders and we never sell. So it's like, what are we going to talk about? So I will make a couple of comments on Naspers, but I'll keep it high level, because the commitment and consistency biases are really real. It's like when you make a public statement about things, it's very hard to go back and change your mind or recognize if there's an error. And so we just don't want to get in that situation. But I will say that Naspers is, so for those who don't know, the incredible thing about Naspers, and people are going to have all sorts of opinions. And in fact, another reason we don't talk about portfolio holdings is because inevitably you will all have different opinions about each different holding. And some of you will love all of them, and many of you will find one or two you don't like. And that will become just the focus for you. And so we try to avoid that. It's like, there's but I will share this with you, and it will hopefully not bother too many of you, but it might become a really, really important situation. So Tencent is potentially one of the best companies in the world. It is one of the largest companies in China, one of the top 3. They own things like WeChat, which has 1 billion users. They have a huge investment portfolio. They are the price is getting whipped around through everything going on with the Chinese Communist Party. And it's basically, we sort of expect, with broad strokes, I think it's fair to say that China's GDP will surpass the US GDP in the next decade or two. And this is one of the largest companies, and it's selling for like 1/3 of the value of the US large companies. And China's going to be bigger, and they have 1 billion users, and the 1 billion users spend like a day. And by the way, they're in everything. It's fintech, it's everything. It's quite remarkable. So that's Tencent. Tencent, we've done quite a bit of work on, and recognize it as being, and it's growing at 35% per year. Okay. It's like smaller than Berkshire Hathaway and making way more money than Berkshire Hathaway and growing at 33%, 35% a year. It's incredible what they've created. What's interesting is that Naspers was a little company in South Africa, and they 20 years ago found this little company called Tencent in China, and they took $20 million and they bought 1/3 of the business for $20 million. And what happened is they then took that home, and Tencent became this behemoth, and Naspers inevitably ended up owning this huge amount, and they are breaking the Johannesburg Exchange. The structural situation is a big problem. So they're the biggest on the Johannesburg Exchange. Now they're 23%. They're hitting all sorts of limits because investors can no longer buy the ETFs because they have too much exposure to NASPERS. And so the management is working through all sorts of things to try to close this valuation gap. What's interesting is if we use just really high level numbers, we think Tencent's worth over $1 trillion right now, but let's say it's 600 billion in the market, and they own about 28% of it or so. Basically, the value of their current Tencent holdings is like a 40% discount. The price of NASPERS is like 40% discount to just how much Tencent they own, and they own other things as well. So there's like call options on other things where they could have other big gains. So we're basically getting this levered play on Tencent through our ownership of NASPERS, and NASPERS management is going through this systematic approach to try to close this valuation gap, but there's a structural issue. So what have they done? They've taken all of their e-commerce subsidiaries and they've spun them out and listed them in Amsterdam as a different e-commerce entity called Prosus. So Prosus now owns, it becomes quite complex, but Prosus now owns Tencent, and then NASPERS owns Prosus. So now Prosus is trading at a valuation gap to Tencent, and then NASPERS is trading at another valuation gap to Prosus. And ultimately, there becomes these super high gaps. We don't know when they'll close, but as Tencent grows, NASPERS and Prosus should also be growing. And management they have a pretty shrewd capital allocation strategy, and they are working very hard to close these gaps. There's all sorts of different political situations because we have situations with China, we have situations in South Africa, but we're monitoring it pretty closely. And it's so attractive to be able to buy one of the biggest companies in the biggest economies in the world that's growing at 35%, selling at a discount to itself, and then through an external entity that somehow is trapped in the system, selling for a deeper discount to this. So if we see Tencent double over the next 5 years, we can see NASPERS go up 4 or 5x. And I don't think that would be I think that growth is still in an infant stage. So it wouldn't be where we stop. It would just keep growing from there. I think I went on too long about NASPERS. I said I wasn't going to say much, but
not at all. So I'm going to ask about more holdings, and you can answer or not answer, but that was very interesting. How about Seritage? This question is about the pandemic affecting Seritage's business, people visiting the mall less, businesses going bankrupt, needing less office space. Can you talk about that?
Yes. That is the highest level, that is the first level concern that everybody thinks about. And that's what actually provided the opportunity in the first place. So these are real. So there are a few types of properties here, and there are really Class A properties, and those are the ones in sort of bucket 1 and 2. And then there's properties in number 3 where they might not be the top properties in the world. There might be a rural Kansas Sears location that they would actually like to liquidate, and then they actually they're calling it recycling their capital, and they're liquidating some properties in order to pay for the development of other properties. Certainly that fear is very real. Ultimately, a year or two from now, people will go back to some form of normal situation. I understand, there's WeWork, there's over commercial development. This is the whole reason that this is such a controversial topic. I will tell you that the shares prior to the pandemic were trading for 40. And when we started buying, they were about 6. So it fell from 40 to 6. And in fact, it was so interesting. And I was going through the debt scenario. So there's a lot of details that is just too much for this meeting, but they have $1.6 billion in debt. And that was the big concern. And that's what everybody was concerned about. But it turns out all that debt was provided by Berkshire Hathaway, and that actually Warren Buffett also owns 8% of the stock personally. And I started going through that debt in a lot of detail, and it was like painful, very painful, these debt write-ups. And so I actually wrote to Danielle, who used to be a corporate lawyer in New York, and I asked for her help and said, can you please explain to me what's going on in these multiple 100-page debt write-up? And she summarized it all and basically explained that it's actually, the covenants are really light. Berkshire is actually there more or less to help, and there's sort of 3 outcomes, and we're watching for each outcome. But it doesn't look like there's, you know, if their cash levels dip below 30 million, for example, their interest rate starts, their interest payments accrue, they don't have to pay in cash. There's all sorts of things that are deeply embedded in these covenants that make it like a joint effort between their debt holders and their equity holders. So I'm not actually concerned about that sort of consideration. They are a prime property real estate manager, and they have tenants and clients that are growing and expanding. They're looking for places to move into. It's more a matter of when Sears can redevelop. So they don't want to move into the old Sears warehouse. It's places like Dick's Sporting Goods. It's places like AMC, which of course has its own issues right now, but will probably be around. It's places like restaurants, Chili's, and these it's Dave & Buster's. Okay, these tenants are expanding across the nation, and they're waiting for places to move into. And as soon as they move in, they start paying rent. And that's all that we're looking at and counting on, is how quickly can they redevelop these? And we really know the value. We have gone through property by property. There used to be 212, and we've analyzed the value of every single one on a fire sale liquidation basis, on a square foot basis. What could they get for it? And we come up with about $4 billion in property value. So if they were to just liquidate this entire portfolio and then pay off their debt to Berkshire Hathaway, they'd still end up with something in the $2 billion range. So this is just a really mispriced situation. The reason it's mispriced is because people do have that view and those concerns. What happens if the pandemic never ends? What happens if people never go back to malls? But you know, it's, as long as the tenants are around, the business is going to be quite successful, and the tenants are doing quite well, and the properties are really in good places. I'll also add one more thing, that, you know, I've left so many things out of Seritage just to make it simple. But one of the main drivers for this is that they're doing what they call densification. So if you've been to, you know, no one here has probably been to a Sears in 20 years, which is why they ran into a problem. But Sears is a one-story warehouse level footprint. And so if you go to downtown Santa Monica, you see that they have 100,000 square feet in the middle of the most expensive real estate, some of the most expensive real estate in North America. And what they're doing is they're building up. So they're going to build a 10-story high rise and turn their 100,000 square feet into 1 million square feet. They're doing the same thing in Redmond, Washington. They're doing all of these densification products where they have commercial on the ground floor, and then they have residential, you know, where they're building up. And so we're doing all our calculations based on just the footprint square foot that they have today, but they actually could end up with many multiples in terms of the revenue that they're bringing in. So I'm really confident they have a really great management team, but we watch very closely. And if anything changes, you know, we will be comfortable selling calls and exiting. But right now it's really attractive. And as I mentioned, it's quite unique to find a situation where we're earning like 42% over a 17-month period selling puts on a stock we want to own anyway, giving us a 30% margin of safety. It's a pretty incredible situation. And by the way, sorry, but I will also add, there are, I'll just let you go and do your own research a little bit, but there are, we are not the only value fund in this position. there are a lot of great partners that own stock. So I mentioned Warren Buffett owns a huge piece. I think Manish Pabrai now owns 10%. I know Guy Spear owns a whole bunch of the shares. There's quite a few people involved that are well-respected value investors. This is a pretty great opportunity.
Okay. Speaking of Manish Pabrai, the next one is asking about Dondo. Can you talk about the progress with Dondo? The questioner says, I hear Outdoorsy is going public. Can you just generally discuss that investment?
Yes. So we've talked about it a bit in the past, and I would say if you're really interested, we have, like, I think last year's meeting, I went through it in detail, and it's up on our YouTube channel. But there's sort of three buckets to Dondo Holdings. Dondo has a little bit of an internal equity portfolio, and it has this sort of private portfolio that includes Outdoorsy, which is going to go public. Excuse me. And then they have their sort of primary asset right now, which is their $100 million India-focused hedge fund. And the interesting thing about Dondo for us is that, first of all, Dondo didn't work out perfectly. It was originally supposed to be this roll-up of these insurance companies. It was going to be a mini Berkshire Hathaway. It was going to be an IPO. And we had an opportunity through the relationship I have with Manish to buy a piece of it. And so the probability of success was very high, but ultimately interest rates remained low for too long. The insurance company was not working out very well. It was difficult for combined ratios to get under 1. And they had to invest premiums in a really low interest rate environment. So it was hard to be profitable and thus hard to do an IPO. So they spun out the insurance entity, and Pabrai is basically returning capital. So we bought in at $10 a share. We've now received $7.50 back, and we hold this at the book value, which is why I mentioned that in the slides. The book value is now around 30 million, but what that consists of is simply the assets minus liabilities of the business. It's the equity that they own, and this small sliver, I think 7 million of it might be the private investment that they made in things like Outdoorsy. So that could actually turn out to be quite good depending on the price when it does IPO. The hedge fund is going to be the longer lasting asset that we own. And it's quite remarkable, I would say, that our fund owns 2.6% or something of Manish Pabrai's India-focused hedge fund. We are super fortunate to be in that position. We expect to get the rest of our $10 paid out as these IPOs occur, as they liquidate the rest of their internal equity portfolio. And now we're sitting here with a ownership of this hedge fund. The hedge fund has about $100 million in it. If you do the math, as they're growing, it's all focused on India. We also have a position we own Talis, of course. Talis is a firm that I set up in Turkey and allows us to get access to some of these really interesting companies throughout these developing markets in the Middle East, and they're trading for like 5 times earnings. What's happening with Dondo Holdings is very similar with what's happening with Talis. There are companies that are selling for such an inexpensive price that at some point they will re-rate. I expect that we could see a situation where the hedge fund, Indian-focused hedge fund, could just return 100% in a year, maybe more. And when that sort of thing starts to happen, as ownerships of that, we will start to receive large dividend payments. And so although this book value and what we're holding it on our financial statements is shrinking and shrinking, it becomes like this hidden asset where when Manish Pabrai's hedge fund, when Dondo Funds does well, we will receive dividend payments, and it could end up giving us a 3, 4, 5% tailwind on like an annual basis. So it could become a really valuable asset for us over time. And again, I really went into detail last year. So if you want to want to look more in at Dondo, just go to our YouTube channel and you can view the meeting from last year.
Good point. That was a great discussion last year. So let's talk about one more company, the company, Berkshire Hathaway. So this questioner is asking how you see Berkshire growing and being priced in the future. He's asking what the assumed growth rate you consider to be reasonable for Berkshire. At 6% growth, it seems to be fully priced. If you assume 10% growth, perhaps it could be going much larger. Do you tend to use conservative growth rates or larger expected growth rates generally when looking at companies, and then specifically at Berkshire?
Yeah, I think we use we are typically very conservative in our calculations. So what I'm looking for is for us to be surprised to the upside, and so if I think about the slide that I was referring to, I think we have a very reasonable, but I think we have a very reasonable growth rate. I think we use a 10% growth rate on the operating earnings of Berkshire. And the surprising thing is that many people, so the surprising thing for me is that I think many people put Berkshire in this category where they just think it's going to stop growing. I get pushback all the time on Berkshire. And it's, I mean, they have like 144 billion in cash that they're probably going to put to work at some point in, say, the next half decade. They may just go and buy like $8 billion in operating earnings. And I mean, I could see a scenario where, operating earnings jump to like $50 billion. And, at a very conservative level, that would suddenly be like maybe a $750 billion valuation. And that's just putting their current cash to work. I mean, they're basically making, about 25 to 30 billion a year now in their operating earnings. And I expect that to grow quite a bit. So we do use conservative estimates. We use about 10% growth on Berkshire. I think, Buffett's been growing the business at about 19% for almost 60 years, and the last 10 years it's come down to like 10 or 11%. People often worry about his age. I think if you really understand the company well, you see that he has all the lieutenants in place to take over. And in fact, Buffett himself has said that he expects the share price to go up, not go down after he dies. So and the reason being that there will be all sorts of speculation on breaking up the company. There will be speculation on paying out dividends. There's going to be all sorts of interesting things that happen. And so Buffett has said that he expects it to go up. And I'll also add, I don't know if I see it down there. I'm not going to get it, but I also will point out on that, to that point, I have this actuarial table behind me. And basically, if you're a healthy 90-year-old, which Buffett seems to be, your life expectancy is 6 years. And if you're a 96-year-old and healthy, your life expectancy is like 4 years. So it's sort of strange to if you're interested in a company like Berkshire, don't try to time it and wait for Buffett to die and there to be a dip. He might be around for a long time. And I think the company will compound quite well. It will outperform the S&P 500. We're able to buy it through structured value. It's a stabilizer in our portfolio. And it basically, in a way, it's a really contrarian play, because when the tide goes out, when there's a crisis, Buffett's standing there with cash waiting to pick up all of these really cheap securities. And so I think it's a really great position to hold in a long-term value fund.
Wonderful. Moving aside now from the specific company questions, a general question about kind of how you manage the portfolio of the fund. This questioner is asking about when do you decide to sell a stock? So you've got all these excellent, strong compounding businesses that are growing over time into their market caps eventually.
Mhm.
When you decide, first of all, when do you see that happening, that they get to that level where you might start thinking about selling some of these long-term holds? And then when that time comes, do you think you plan to sell covered calls to sell? Will you immediately exit? Will you tranche your way out? How do you manage that
Yeah.
decision about when and how to sell any of these companies?
That's a great question. It's a perfect question. So, our selling discipline is pretty strict. Ideally, by the way, we want to own these Fisher compounders. In an ideal scenario, we never have to sell, because that means that the business value is growing, and we're, seeing the stock price rise, but the business continues to grow. But of course, we have situations like a Graham type value investment where it becomes full valued. So when we sell is when the equity price is matching our valuation of the business. And so high level, we do use covered calls. We would definitely sell with a call, and we will price those covered calls typically in a matrix where we will have various strike prices, varying premiums, and we will also have different expiration dates. So it becomes like a cost averaging sale over time, and the premiums, and the best way to probably do this as an example. So if you think back to the generic $100 stock we referred to, we might have bought that stock or sold a put on that stock and picked it up for $75 after receiving a $25 premium. And maybe we did that because we anticipated that the shares were going to grow to $750. So if the shares quickly rise to $750, and as few years have gone by perhaps, when we get to $750, what's amazing is that the call premiums will be quite high. And so because the shares have run up so much. So as the call, if we think the value is 750 and the market price approaching, say, 700, we will start selling covered calls with a strike of 750, going out into the future. And we might pick up, let's say, $100 for that premium. So what we'll ultimately do is we'll be entering in the stock for 75 instead of 100, and we'll be exiting for 850 instead of 750. So basically, when it reaches its full value, or when it reaches a point where it's overrun its value to a level that we don't expect the compounded gains to be very high, then we'll start exiting. Of all the infinite compounders that are on our previous slide, I think the one that has a potential to reach that level would actually be Seritage. So we could find ourselves down the road in a situation where the properties have been redeveloped, the revenue's coming in, they reinstitute a dividend as a REIT, everybody's interested, the price goes up quite a bit, the price could go up quite high, and suddenly we have this $4 billion market cap firm, and it's just brick and mortar real estate. It doesn't, that is something that ultimately we will find an exit. I don't think it's an infinite compounder in quite the same way that some of the other businesses are. And so we are, constantly valuing the businesses, and basically when it reaches its full value, we exit through a covered call.
Great, detailed. Finally, I think as we're coming to the end of our time here, this is a fantastic general question asking, what are you most optimistic about generally, globally, in the market? And then what concerns you in the same way?
Interesting question and great question. It might be the same, it might be the same thing. So one thing that has me very optimistic and very concerned is that for a year, I think we were very fortunate because I recognized immediately, this is the third crisis that I've been investing through professionally. And I recognized immediately that the actions being taken had key components that were different. So in the financial crisis, for example, all this bailout money went to banks, but they had a lot of trouble lending it. Milton Friedman used to talk about M1 and M2 capital being like the key lever to really stimulating the economy. So that's money that goes directly to people, but they didn't really know how to do it. And this time around, they just printed money and mailed out checks. And they have put, the Fed, the Treasury, and Congress has put so much money and stimulus into the economy. I don't think we're in like the beginning stages of an economic recovery, but there's just money everywhere. And so although we have like reasonably high, I think by any standard you say, well, the market's kind of high, but it's like 22 times earnings maybe, and we're in a zero interest rate environment. So if you invert that, you get like somewhat like a 4 to 5% earnings yield on stock. That's actually the right amount. If treasuries are giving you 1.5, you get like a 3% risk premium. Now you're at 4.5. So it's like the prices are actually right. And the economy is growing so strongly and so well. I understand that this pandemic has hit all sorts of people in all sorts of different ways, and it's been devastating. But from an economic perspective, I think that the US and some other governments, economically speaking, have actually handled it they've handled it really well. And it almost in a surprising way. Now, I know there's concerns about it. It's like, why are we mailing all this money? And that's the flip side of all of this is, for years, actually, for many years, I was saying, where's the inflation? Inflation is supposed to be here. And suddenly we haven't seen it. There's been no inflation. And the Fed has been trying to create inflation. And it seems improbable that you could dump this much money onto an economy and not see inflation. But there are smart people on both sides of this aisle that basically are arguing back and forth about deflation because of demographics and inflation because of stimulus. And, I don't think it's knowable. So it's a very interesting debate. I think that the economic recovery that we're seeing in the US has me very optimistic. Our portfolio has me very optimistic. The firms that we own are doing extraordinarily well. But my biggest fear is that for political reasons, we struggle to raise interest rates. I don't want to see really high interest rates either, but we struggle to raise them. And then we end up in a situation where the Fed's behind the curve on inflation. And if we get, 8-10% inflation, we're back to the Volcker years in the 70s. And now we have to counteract that with really high interest rates. If that were to happen, it would impact things because interest rates are like gravity. So when interest rates are low, asset prices can be high. But when interest rates go high, people would rather own a bond than equity. And so equity, the yield, the earnings yield on equity has to increase, which means the price would have to be lower. That said, so inflation is the fear and stimulus keeps us optimistic. And it's the opposite side of the same coin. And the outcome, ultimately, I want to just be clear, you have to do this bottom-up analysis of individual securities to get around this. So you have to ask yourself, will Daily Journal be impacted by high inflation? And of course, at the margin, the answer is it will be slightly, but because of the management teams running it, and specifically because of things that I know, like in these contracts, so they're writing contracts, they're doing a SaaS model for these government agencies, courthouses around the nation. In each of these contracts, they have a KPI price inflator. So if inflation goes up 10%, the price of the contract goes up 10%. So in reality, inflation won't impact Daily Journal the same way that it would impact like an OEM manufacturer like a GM or Ford. Inflation would hit those types of businesses much harder. Inflation would hit things like restaurant owners much harder, especially like high cost of labor. Probably see some wage inflation. So you can sort of sidestep some of the problems, but the fear overall is inflation, and the current stimulus and the way the economy is moving has me very optimistic.
I recently read some of Buffett's letters from the 70s during the time of high inflation, and he said that the things to look for in companies during that kind of economic situation are low debt and an incredibly strong moat in which a company can raise its prices commensurate with the inflation and perhaps beyond, which is what you just described.
That's right.
Very interesting.
Yeah.
Wonderful. Thank you. We have a few additional questions that have been filtering in right here at the end, and I am going to copy those and make sure I send them to Matthew. You guys can also email him directly. You have the email right on the meeting invitation that came in, and I'm sure he'd be happy to chat with you more about those. I'm sorry we couldn't get to all of them. But this concludes the Peterson Capital Management Annual Meeting. Matthew, thank you for your time. Thank you to everybody here who attended, especially my fellow European late night compadres, Toby. We made it. Again, if you have questions that were not answered or that you didn't even get a chance to put in the chat, just email Matthew about it. I'm sure he'd be happy to chat about it. So Matthew, please now, if you have a few final words to close the meeting.
Sure. Thank you, Danielle. Thank you very much. And Andrew and Shanak, thank you very much for your presentations. I think those were really wonderful. And of course, to everyone on the call, thank you for joining. Thank you all for taking the time to be here today. I will share with you, it is a very exciting time. This next quarter marks the beginning of our second decade, and the potential we have is very impressive. Our next close date for capital is September 30th. And this is really not the time to be shy. Send me an email. You should really be adding capital, definitely sharing with your friends what you have found. It is the reward of a lifetime to continue working with such incredible partners. Your long-term vision allows us to plant these seeds for enormous wealth creation in the years to come. So thank you all for being here. It is a true pleasure hosting this meeting with you today.